Thank you for joining another episode of the Investors Gate podcast. I'm your host, Austin Denoche, and today I'm going to be talking about a lot of dense information, so feel free to pause or pick up some notes because I'm going to go pretty fast. But I'll be discussing global trade, currency wars, and a little bit of history behind that, and historic devaluations, as well as the monetization of debt and how all that plays into the United States' role as the reserve currency. All right, let's do it. So global trade, in a nutshell, consists of various trading surpluses and deficits between countries. Surpluses occur when countries export more than they import, which leads to more money coming in than going out, and deficits occur when nations, like the US, import more than they export, meaning more money is leaving than coming in. I'll discuss the US's particular situation, as it's exceptionally unique, but generally speaking, trade has to do with geographic availability of resources, a country's domestic demand, and a country's desire for economic growth. Many countries, because of where they are and what resources are directly available to them, must import goods for their economy to function. Examples of this are Japan's need to import oil because of its scarcity on their island, and Europe's dependence on Russia's natural gas to heat their homes, among other things. It just happens to be the case that certain resources are not available everywhere or simply not available in the amounts needed, so countries are forced to import those resources from other countries where they are more abundant. In addition to this geographic dependence driving trade, there is purely economically driven trade through competitive pricing. If one nation can sell a good or service cheaper than your domestic economy, that creates demand for trade and more imports from those countries offering better prices. The most widely known case of this today is China selling cheap goods to the US and much of the developed world. The US and others could pay more to buy those goods domestically, but competitive prices drive everyone to buy those goods from wherever they can be made cheapest, in this case China. Now normally this is just a way of the world and part of the free market, but quite often countries find it too difficult to compete with outside nations and are forced to intervene to remain competitive. And this can be done through things like tariffs, trade taxes, or embargoes, trade bans. When a country's economy is struggling to stay competitive in the face of cheaper foreign goods, sometimes the best way to reignite that domestic demand is just to make those foreign goods more expensive through taxation or the outright banning of those goods through embargoes. By eliminating the price advantage of foreign nations, demand for domestic goods will go up and begin to balance any trading deficits. While this is mostly done for practical reasons to bolster one's economy, it's often done punitively through sanctions. Now, sanctions can manifest in a number of ways, including tariffs and trade embargoes, and that'll be what I'm focusing on here. Sanctions are often political in nature and used to punish bad actors for a variety of reasons and allow countries to exercise power or penalize other countries for certain behavior without resorting to violence or hollow threats. Rather, they attack a country's economic profits. And if you are the reserve currency, like the US, which I'll get into later, sanctions can effectively bar nations from world trade, which is often quite devastating to an economy. Another way countries can compete with others in global trade is through currency wars. Countries that issue their own currency and thus have the power to manipulate its strength and weakness through quantitative easing and tightening can engage in strategic devaluations. If your country is generating a trading deficit from importing too much due to a stronger currency, that country can ease monetary policy to weaken their currency. In doing so, imports will become more expensive, but exports will become more desirable to foreigners as their currency would become stronger relative to that weakening currency. In other words, strategically devaluing your currency can shift the tide so you become a trade surplus nation as more countries find your goods denominated in your weakening currency cheaper. But after a certain amount of devaluation, inflation can begin to run hot and monetary policy will begin to tighten until that cycle starts over again. And one of the interesting things about the devaluing and strengthening of one's currency is it can lead to the exportation of inflation or deflation. If one country weakens its currency, that will lead to other countries importing deflation from that country due to the new relative strength of their own currency. Conversely, if a nation strengthens their currency, it can lead to other countries importing inflation with their weakening currency relative to that strengthening one abroad. This adds a fascinating dynamic to currency wars, as they have implications for economies around the world, not just the country engaging in the devaluing or strengthening of their own currency. Now, while currency wars are usually used as strategic moves on this global chessboard, there are instances of devaluation leading to the destruction of a nation. The Weimar Republic is a prime example of this happening. After World War I, Germany was charged with paying basically an unserviceable amount of reparations for the war and decided it would simply print its way out of those debts. Eventually, the never-ending printing of the German mark led to it being worth no more than the paper and ink used to print it, and so the nation devalued its currency into collapse, which was actually a significant factor leading to Germany's role in World War II years later. A more successful use of devaluation occurred under FDR during the Great Depression. At the time, the dollar was pegged to gold at $25 per ounce, but FDR needed to find a way to stimulate the economy, so he confiscated all the gold and proceeded to change the exchange rate to $35 per ounce to increase exports with the cheaper dollar and give him and the government considerable wiggle room for economic stimulus. And this newly devalued dollar did lead to a massive increase in exports as the price of U.S. goods became extremely enticing for foreigners. So the strategy worked to stimulate the struggling economy, but eventually drove other countries to devalue as well to remain competitive. With the weaker dollar FDR created, countries were importing deflation and had to weaken their own currencies to avoid losing their competitive edge, substantial trading deficits, or monetary deflation that could create their own Great Depression-like environment. So currency wars became a race to the bottom in some sense, with nations taking turns devaluing their currencies to stay competitive. Another example of strategic devaluation was Nixon removing the gold peg in 1971. This devaluation was really because the United States couldn't service its liabilities under the gold standard and had to transition their monetary policy to avoid losing more gold reserves. So switching to a system where banks could print instead allowed greater flexibility for the economy, but it eventually set the stage for a much weaker dollar and the extremely high inflation of the 70s. After a very large devaluation, Chair Volcker, the Jerome Powell of the time, raised rates through the roof in hopes of curbing that inflation. Eventually, his efforts would work, but it set the groundwork for a massive dollar bull run in the 80s, which brings us to the Plaza Accord. The Plaza Accord was an agreement among the 5 biggest economic powers at the time, including the United States, to collectively devalue the United States dollar to better facilitate global trade and economic growth. With so much of trade dependent on the United States and the petrodollar forcing so many goods to be priced in USD, the strong dollar was beginning to stifle economies abroad. So shortly after, the dollar began to weaken, and other economies like Japan actually began to experience significant deflation, which led to the widely known lost decade, as they like to refer to it. Now, the purpose of explaining all this is just to show it's fairly common for countries to strategically manipulate currencies for both selfish and global purposes. And given the economic interconnectedness of the world from global trade, the change of one currency's strength can have serious implications for the rest of the world's currencies. So with this scene of currency manipulation now painted, I wanted to talk about the reserve currency because the uniqueness of that role is incredibly important. So I'll just start by explaining what the reserve currency is. A reserve currency is a currency countries keep or hold in their reserves for trading purposes. With so many countries engaging in trade, it would be really complicated to trade in a dozen or more currencies, so most countries hold a large amount of select and widely held currencies, usually those of the countries that do the most trading, like the United States, Europe, and China. Today, most reserves, about 60%, are held in USD, and that is primarily due to the petrodollar, which I alluded to earlier. The petrodollar emerged post-gold standard and was the Nixon administration's kind of clever way of creating demand for a currency not backed by a hard asset like gold, which is exactly what they were creating by eliminating the gold peg. So to create demand for this seemingly meaningless piece of paper, the United States coordinated a global pricing of oil and other commodities in dollars. If countries wanted to buy oil or what have you, they had to pay in dollars. And so this created significant demand for United States dollars and motivation to hold a lot of USD in one's reserves. But that demand for USD as the global reserve currency was actually partly why the US had to go off the gold standard in the first place. Because all these other nations wanted and needed to accumulate USD for trade, more and more money, gold, was flowing out of the US to accommodate all that foreign demand. To get those dollars, countries would generate trading surpluses with the US, meaning the US had to generate trading deficits with every other country. And this leads to what is known as the Triffin paradox. If a single nation has the global reserve currency, they have to generate massive deficits with the rest of the world to supply enough of that currency to facilitate global trade. If they don't generate deficits with other countries, those countries won't have enough money to buy oil or whatever else is priced in dollars. So this is why we see the US with such aggressive trading deficits. This somewhat artificial demand for USD essentially encourages never-ending deficit spending and money printing to remain accommodative to global trade. Normally, deficit spending or inflation from money printing lowers the demand for a currency because it's being devalued. But the demand created through the petrodollar system has actually allowed the dollar to expand well beyond what would normally be economically tenable. Government debt can skyrocket due to all the artificial demand created through the global pricing of goods in dollars. And instead of a balanced system where debts and fiscal spending are financed through taxation, bond issuances, or trading surpluses, the United States is kind of forced to finance the global demand for dollars by printing and selling debt to foreigners. Foreigners need dollars, so they'll buy that debt to hold those dollars in their reserves as treasuries while also earning a yield that the US is supposed to eventually pay. But in periods of a strengthening dollar, where other nations struggle to buy more US debt, the US is forced to buy their own debt to finance spending, especially if the lack of demand for treasuries is pushing interest rates higher and forcing the US to pay considerably more interest on all that debt they've issued. All right, so what does this all mean? In simple terms, it means we're fucked. A nation with a global reserve currency pretty much has to run these massive deficits to be the global reserve currency. And that means outsourcing more and more of its economy to other nations through those deficits, which hollows out the economy until debts are so high that the US can't afford to pay them and the whole petrodollar system collapses on itself. On the gold standard, these problems were usually self-correcting because you couldn't spend more gold than you had, and trading deficits would eventually lead to a nation strapped for gold, which would then lead to more exports to earn more gold, which led to surpluses and gold inflows, which corrected any crazy deficits. So it's this inability of a global reserve currency belonging to a single nation to self-correct that makes the United States situation so problematic. Now, the IMF, the International Monetary Fund, has attempted to solve this through what's called the SDR, Special Drawing Rights, which is basically a basket of currencies that can act as a unit of account and take the place of the dollar, but it hasn't really gained much traction and doesn't really solve the fundamental problems of fiat. It might help the US work on fixing their trading deficits by creating lower demand for dollars and also providing the liquidity global trade demands, but it doesn't really solve the dishonesty or manipulation associated with fiat. And now I don't think we should necessarily do away with fiat currencies altogether, as the flexibility they afford can be very helpful at times to soften business cycles or black swan events, which historically has usually been the ability to finance wars. But transitioning economies and the global unit of account back to a hard asset like gold or Bitcoin would, one, lead to naturally balanced global trade via honest accounting out of necessity, and two, largely eliminate the ability for countries to engage in currency warfare, because currency strength and weakness would be more the result of the actual economy, not manipulated interest rates and money printing. You might lose some of the flexibility of the fiat system, but the inelastic nature of hard assets is exactly what keeps this system from expanding far beyond its fundamentals. So I know that was a lot of information to digest, but let's highlight some of the takeaways. First, countries use policy rather than free markets to manipulate their currencies for more desirable short-term economic and trading circumstances, or to avoid their own financial responsibilities like debt obligations. Think Nixon bailing on the gold standard to avoid all the gold liabilities. Second, the current reserve currency petrodollar system incentivizes deficit spending by the US and really has no end until something breaks and those debts finally come back to bite the US in the ass. And finally, moving back to a fixed exchange system where currency is backed by a real asset can move us back to honest accounting and solve many of the problems fiat has created. Now, whether that's gold or Bitcoin or something else, I suppose it doesn't really matter, but my vote is for Bitcoin. So hopefully all that was at least somewhat digestible and helpful in explaining how the global monetary system works. It's a crazy topic you can spend a lifetime studying, so I encourage you to learn more because this was by no means exhaustive, and we're approaching a point where this system is beginning to shift in a major way. All right, well, that's all I have for you today. As always, I appreciate you taking the time to listen to all this and wish you the best of luck.